Hello, it's MrELoans.com, bringing you some information about a second mortgage in Chula Vista, California. A second mortgage usually refers to a loan that is subordinate to another loan on the same property or home. A second mortgage is subordinate because if the property goes into foreclosure, the first mortgage gets paid off before the second. This makes a second mortgage much more riskier to a bank, and that is generally why second mortgages come with higher interest rates. A home can have multiple mortgages or liens on it. The liens are recorded with the city or the county that the property is located in. The lien that is registered on the property is called the first mortgage, and the second lien that is recorded on the property is called the second mortgage. Properties can even have more than two liens against them, but it is somewhat rare in today's market. A second mortgage is generally referred to as a home equity loan. A homeowner is basically borrowing a proposed amount of equity that is in their home. The amount that the home borrower can borrow is dictated by the appraised value of the property and the bank's loan-to-value ratio. Most banks will not lend more than 65 to 85% of a home's value on a home equity loan. So in order to qualify for a second mortgage, you must have a substantial amount of equity in your home or have paid off a large portion of the principal. Second mortgages usually come as a fixed loan amount or an equity line of credit. If a borrower gets a fixed loan amount, they will receive one lump sum of their equity up front. If the borrower gets a home equity line of credit, which is known as a HELOC, they will be allotted amount of money that they can use whenever they need, similar to a credit card. Many borrowers prefer home equity lines of credits to fixed loan amounts because they can use the money as needed. This allows a borrower to only pay interest on what they owe. With the fixed loan amount, a borrower has to pay interest on the entire amount of money that is taken out, even if they do not need to use all that money at once. The benefit of a fixed loan amount on a home equity loan is that they are generally fixed rate mortgages. Home equity lines of credit are typically adjustable rate mortgages. If you have additional questions about how a second mortgage works or are interested in seeing if you qualify for one, please visit MrELoans.com for more free information.